You can have a strategy that wins 55% of the time, has a real edge, positive expectancy, and still have a 1 in 3 chance of going broke. That's not bad luck. That's math you can calculate in advance. This is educational commentary, not personalized financial advice, but by the end of this video, you'll be able to look at your own account and estimate how likely you are to blow it up before your edge ever pays off. Here's why this matters right now. Trading has never been cheaper or faster to access. Zero-commission apps, fractional shares, weekly options. And the story everyone tells themselves is simple: find an edge and the money follows. But survival and edge are two different questions. Edge tells you where you're going. Risk of ruin tells you whether you live long enough to get there. So let's name the misconception directly, because almost every retail trader holds it. The belief is, if my strategy is profitable over time, then given enough trades, I'll come out ahead. It feels airtight. Positive expectancy plus a large sample equals profit. But that sentence quietly assumes one thing: that you're still in the game for the large sample. And that's exactly the assumption that fails. Let's make it concrete with the simplest possible case. Forget options. Imagine a coin that lands heads 55% of the time. You bet on heads. Win, you double your stake. Lose, you lose it. This is a fantastic game, a 10% edge on every flip. No casino on earth offers you this. So you should never go broke, right? Watch what happens. You start with $100, but you're eager, so you bet $20 a flip, 5 units of capital. The coin doesn't care about your average. It delivers streaks. A run of 4 or 5 losses in a row isn't rare. Over a few hundred flips, it's almost guaranteed to happen. And with only 5 units in front of you, one ugly cluster of losses ends the game. Run the math on this exact setup, and your probability of ruin is about 37%. Now change one thing. Same coin, same edge, but you bet $10 a flip instead of 20. Now you have 10 units of capital to absorb streaks. Your risk of ruin drops from 37% to about 13%. You didn't improve your strategy at all. You didn't get smarter. You just gave variance less room to kill you. That is the entire lesson in one comparison. Your bet size, not your edge, controls whether you survive. Here's the aha sentence, and I want you to keep it. Your edge decides how much you make. Your bet size decides whether you're alive to make it. Two traders with the identical winning system can have completely different fates, and the only difference between them is how much they risk per trade. The market pays your edge over the long run, but only to accounts that reach the long run. Now the part that makes ruin sneakier than people expect. The math of recovery is not symmetric. Lose 20% of your account and you need a 25% gain just to get back to even. Lose 50%, you need to double your money, a 100% return to break even. Lose 80% and you need 400%. Losses compound against you faster than gains compound for you. So a big drawdown isn't just painful, it mathematically steepens the climb back. That asymmetry is why deep drawdowns so often become permanent. Let's move this from the coin to a real trading desk. Say you day trade SPY options with a genuine edge, a setup that wins 55% of the time with roughly even payoff. Good. But you're sizing each trade at 15% of your account because the setup feels strong. String together 5 losers, which will happen this quarter, and you've torched more than half your capital. Your edge is intact. Your account is not. You'll spend the next 6 months clawing back to flat, and most people quit or tilt long before that. This is where the Kelly criterion comes in, not as a magic number, but as a ceiling. Kelly tells you the bet size that maximizes long-run growth. For our 55% even money coin, Full Kelly says bet 10% of your bankroll. Here's the twist most people miss. Betting more than Kelly doesn't just add risk, it actually lowers your long-run growth while raising ruin. There's a size beyond which working harder and betting bigger makes you both poorer and more likely to go bust. And that's why serious traders bet fractional Kelly, a half or even a quarter of the theoretical optimum. Why give up growth on purpose? Because the Kelly math assumes you know your edge exactly. You don't. Your real win rate is an estimate, and it drifts. Cutting your size in half barely dents your long-run return but slashes the depth of your drawdowns dramatically. You're buying insurance against being wrong about how good you are. That is humility priced correctly. So what does a disciplined trader actually do with this? 3 things. First, they fix risk per trade as a small, constant fraction of capital, often 1 to 2%, so no single trade and no normal streak can threaten the account. Second, they think in units, not dollars. How many losing trades in a row can I take and still be standing? If the answer is under 10, they're oversized. Third, they respect the recovery asymmetry. They cap their max drawdown before the math turns a bad month into a dead account. Here's where this transfers far beyond trading. Anytime you have an edge that pays off over many repetitions, a business, a poker game, a portfolio of bets, the same two questions apply. Is my expectancy positive, and is my bet size small enough to survive the variance on the way to that expectancy? A brilliant strategy sized recklessly loses to a mediocre strategy sized with discipline. Every single time the sample gets large. So before your next trade, don't just ask whether you have an edge. Ask how many losses in a row it takes to end you, and then size so that number is comfortably larger than any streak you'll realistically face. Survival isn't the boring part of trading, it's the whole game. If breaking numbers down like this changes how you see the market, subscribe. We do signal, not hype. Trade the process, protect the downside, and let the edge do its slow work.